We have just a few minutes left in our trading day, so let's welcome in our team from Charles Schwab to get the big picture on our session today. Joining us are Kevin Gordon, our senior investment strategist at Charles Schwab, and Nate Peterson, the director of derivatives analysis for the Schwab Center for Financial Research. Now, Kevin, we'll start with you. We saw a little bit of weakness in the NASDAQ today, but, overall a great week performance-wise, and the S&P knocking on the door of an all-time high. What are your takeaways on the session?
Yeah, I mean, today, notwithstanding, because there's a little bit of weakness from tech, there actually has been, a pretty significant rebound in breadth for that sector. And it's not just driven by, whether you think about NVIDIA for tech or even Microsoft for tech. It's not just a mega cap story or a single name story. The breadth in that sector, even in the industry for semiconductors, and importantly, has been pretty broad-based and pretty strong. You've got close to 80% of the names in that industry that are trading above their 200-day moving average. So I think that, a lot of the story with tech gaining a lot of momentum, and even tech adjacent parts of the market gaining a lot of momentum recently, is good in the context that the health of this rally and the broadness of it has broadly remained in there, especially with industrials and financials still showing relative signs of leadership and strength. I think it's a relatively healthy sign.
And Kevin, Nathan, is there anything that you're seeing in terms of the technicals for the S&P? We hit that intraday all-time high, but we're hoping for one at close. Not sure. We might get there as I look at the board.
Well, first I'll say, momentum begets momentum. The trend is your friend. The dip buyers are getting rewarded. As long as they continue to get rewarded, it's really difficult to kind of, break them free from that buy key. But I will say this on the technicals, last week, we did get some consolidation, a little bit of a pullback earlier in this week. We were at a 75, 76 RSI on the S&P 500. It's funny, Marley, if you go back to last summer, we had a similar type of a melt up and we ran up to roughly an 81 RSI in the S&P 500. We got a little bit of a pullback. We got new highs in the S&P, which was met with a relatively lower RSI reading. That's called a negative divergence. And from there, the markets rolled over. Now, it was tied, that was the excuse, I believe, to the unwind of the yen carry trade. But what you want to look for from a technical perspective is either a negative divergence in the RSI. You can't say that it's happened today, because if we continue to move higher in the coming days and we establish a new RSI, that will negate the negative divergence. So just keep it on your watch list. The other thing that I might look for is some type of those reversal patterns on the charts. Get your candlestick charts out. You can look for something like a shooting star, a dark cloud cover, a gravestone doji, a bearish engulfing candle, or you could also look for the stock market selling off on good news, which right now we're in this good news is good news, bad news is good news, any trade deal is clarity. Look for that sentiment or that price action. Look for the price action to tell you that potentially we might have a shift, because seasonality is about to not be our friend here in the coming weeks. We'll see if earnings will be enough to kind of keep this momentum going up into August.
And Nate, staying with you for a moment, I know we were slightly overbought coming into this week. Are we seeing consolidation, and are we trending bullish or bearish?
Yeah, we got some consolidation at the beginning of the week. We did get some of that digestion. Now, look, you can consolidate by going down or you can consolidate by going sideways. But right now, for example, the RSI, the relative strength index on the S&P 500 is 71. If you look at the S&P 500 over the past 5 years, it doesn't spend a lot of time over 70. Generally, when you get into this area, you tend to get some kind of consolidation or pullback to digest some of those gains, take some of those profits. If you look over the last 5 years in terms of what are the extremes, we just hit 76 last week. Well, we've been at 82, 81, and 82 three times over the past 5 years, one being last summer in July. It feels a little bit similar to that. And then the other two going back to 2023 December, and then back to September of 2020. So just keep in mind, are we overbought? Yes. Does momentum persist? Yes. Are you going to get a bell where everybody tells you, okay, it's time to mean revert? No. So it's up to the individual trader to keep an eye on the charts, on the price action, on that negative divergence in the RSI.
Thanks, Nate. And Kevin, coming back to you, we did get it's pretty sparse in terms of data right now, but we did get initial claims. Was a decent report. They came in under estimates, pretty significantly under estimates. But I would love to get your overall thoughts on the labor market right now.
Yeah, I mean, the split in claims between initial and continuing is really what the big story is. I mean, has been for pretty much the entire year. I mean, initial claims, even in the times that they've risen earlier this year, that's been mostly reflective of a seasonal pattern that you tend to see heading into the summer. Now we're at the sort of back end of that, where you tend to see that pressure ease a little bit, where initial claims roll over. The weaker spot has been in continuing claims. So the people who just can't find another job and have to stay on that unemployment insurance. Continuing claims at a new cycle high, this past week. So there is still a lot more stress exacerbated by that low hiring, low firing environment, where if you have been in the unfortunate position of losing your job, it's just a much harder and much more difficult environment to get another job. But that's not necessarily consistent with the broader economy or broader labor market, falling apart all at once, which is what you tend to see, when you're going into a recession. So that split is really important to highlight, because there's really only so long that you can last with continuing claims drifting higher and making a new cycle high while initial claims stay relatively low. But we also know that, post-COVID has been a relatively unique set of circumstances for the broader economy, but also for the labor market. So I think the pressure point and the weakness for continuing claims is notable, but it's not alone probably enough to drive us into a full-blown labor cycle and then into a recession. So I think that differential, at least for claims data, is going to be really important moving forward.
Well, thank you, Kevin. A unique set of circumstances is a phrase I think we could apply to a lot of things right now as we discuss markets and finance. But I want to thank you both for your time. Kevin Gordon, Charles Schwab, and Nathan Peterson from the Schwab Center for Financial Research.